Good morning to people from India and good evening to the people in the United States and Canada. Well, in this session, we have four very interesting and important papers. I will not make any interventions at this stage or even at the latter stage. They're all very interesting papers. It was a pleasure reading all these papers. In the interest of saving time for the presenters and sort of discussant and all the people who want to ask questions. So let me straight away start. Invite Dr. Igor Malkov to speak on the welfare effects of labor income tax changes on married couples. Dr. Malkov is with the University of Minnesota and Federal Reserve Bank of Minneapolis in the United States. Yeah, Dr. Malkov.
Thank you. So can everyone see my screen?
No, you will have something like 15 minutes to make a presentation. That will be followed by 5 minutes of discussion comments and then 5 minutes of discussion. Yeah.
Yes. So can you see my screen?
Yes.
Yeah. Thank you. Thank you very much. So let me thank you very much for everyone to attend this session. So I want to talk about my project called Welfare Effects of the Labor Income Tax Changes on Married Couples. So the question about labor in taxation of couples is a very important topic to study by a few reasons. So let me just list some of them. The first, the scope. The married couples constitute a significant fraction of taxpayers and the households. So for example, if you take the United States, so the number of married couples constitute almost half of all the households. And also if we look at the data on the tax returns, the number of tax returns submitted by married people jointly constitutes more than 1/3 of all tax returns. The second reason is inequality and the presence of positive assortative mating or similarity between spouses. So the feature that is documented empirically for many countries, both in Asia, in Europe, and in North America or Latin America. So the presence of this positive assortative mating between spouses raised concerns that this can be one of the driving forces of income inequality. And hence we need to think about income taxation as one of the mechanisms through which we can redistribute the income. So the third reason is that in many countries, in the United States, in European countries such as Germany, the tax system creates significant disincentive effects for married as opposed to single women's labor supply. So I will talk more about it in the next slide. But in short words, the reason is that in these countries, the tax unit is actually household rather than individual. And so the couples are taxed based on their joint income rather than individual income. And so if a secondary earner, and in most cases this is a woman, wife, so if she decides to join the labor force and start working, then the marginal tax rate on the first dollar earned by her is equal to the marginal tax rate earned on the last dollar earned of her husband, or primary earner. So in this paper, I asked what are the welfare effects of labor income tax changes on couples. In the literature, traditionally another group had a lot of attention. Another group that is sensitive to tax changes, as single mothers. However, there are two crucial differences between the household that are single mothers and married couples. The first is that single mothers mainly represent the lower end of the income distribution, and hence the very same tax reform may differently affect single mothers who are in general poorer and married couples who are in general have higher income. And second, when we model household as a single person, of course, we omit and don't take into account any within household interaction between spouses that they just do not present. So this is a quick explanation why it is important to think about participation margin when we think about taxation of couples. So this is so here I draw the marginal tax rates, the participation tax rate for two women. In blue, we can see a woman who is married, and in red we can see women who is single. Two identical women. The only difference between them is one is married and another one is single. So when married woman who has a working husband, when she joins the labor force, when she starts working, her marginal tax rate on the first earned dollar, as we can see here, is around 35, 36%. As opposed to single woman, when she starts working, so initially her earnings are subsidized. So when she has a negative marginal tax rate. Okay, so what I do in this paper, first I develop a simple model that allows me to evaluate the welfare effects of labor income tax reforms on married couples. And as a result, I derive a sufficient statistics formula in terms of empirically estimable objects. Second, I apply this framework to 4 tax reforms implemented in the United States over the last 4 decades. And I show that this reform created welfare gains ranging from minus 2.2% to 0.6% of aggregate labor income. I show that these aggregate results mask significant heterogeneity in welfare gains, and so each reform created both winners and losers. Also, I show like there is a quantitative importance of accounting for spousal cross elasticity. So it's very important to study the framework when the households are more as couples, two individual entity. And then in the end, but I think due to the interest of time, I will not talk about it today. I show one source of bias, how sized this bias that arises when we when we estimate the dead weight losses, but when we assume that the tax function is linear as opposed to non-linear. Okay, let me jump to the model. So the model is quite simple. It's static unitary model of couples. I abstract from marriage because I'm looking at actually a very short period of time just before and after reform. So each couple is comprised of a male and a female. Males choose how much to work. Females choose whether to work, and conditional on this decision, they choose how much to work. And also couple choose how much to consume. So utility of couple is given with some generic form. To model participation for women, I impose some fixed cost of some fixed utility cost that are heterogeneous in the population, that are captured by variable Q. So a couple bears this utility cost in case when a woman starts working in the labor market. So the budget constraint is standard. Here I want to emphasize the tax and transfer function and parameter theta. So this parameter theta captures some characteristics of tax reform, and then when later I will consider the tax reform, it will be captured by the marginal change in this parameter theta. So 2 tax rates that will be important for the analysis are first marginal tax rate, standard definition, and participation tax rate that shows by how much the tax liability of a couple changes when a secondary earner, a woman, starts working. Okay, so again, due to the interest of time, I want to skip all the derivations. So basically, to get the measure of welfare, to get the measure of aggregate excess burden, we need to solve the expenditure minimization problem for each couple and derive the compensated functions, compensated labor supply, compensated consumption. So, and then, so let me skip this. So, and then after solving these problems, we need somehow to define the measure of aggregate excess burden. So the most common measure is the equivalent is through the equivalent variation. So we are interested in how much each couple is willing to pay to move from distortionary tax system characterized by parameter theta to the lump sum tax system, so to non-distortionary tax system. So and this basically, if we remember from the basic microeconomic classes, so this Harberger triangle that measures deadweight losses. So essentially here, I measure the Harberger triangle, the deadweight loss for every single couple. And then I sum up over all the couples, with the differences that here we consider not just the choice of hours, but also the participation choice. So this is the aggregate deadweight loss. So then we're interested how much it changes following the tax reform captured by marginal changes theta. And so we have this expression for the marginal aggregate excess burden. However, this is a bunch of endogenous objects, and we're interested that if we want to map it to the data, we want to express it in terms of some terms that can be quantified from the data. So I do this, and then we obtain the sufficient statistic formula that shows the marginal aggregate excess burden as a share of aggregate labor income. So, and it's comprised of several effects. So, namely the distortions that are changed through the male hours channel, through the female hours channel, through the female participation, and through cross effects of the couple. So, if the tax rate on my spouses changes, how much I change my hours. So there are two types of terms. The red terms are elasticities, and I take the values for these elasticities from the literature. And blue terms that are labor income shares, the tax levels, pre-reform tax levels, and reform-induced changes in tax rates. I take it from the microdata. Okay. So let me skip this and move to the quantitative results. So I want to take this formula, and now I want to find the empirical analogs of the terms that we have just seen. So I take 4 tax reforms implemented in the United States of the last 4 decades. For the microdata, I use the current population survey for the United States, and I took married couples who were spouses aged 25 to 54. So I abstract from, because I don't want to take into account any educational or retirement decisions. And to be consistent with the model, I hold all the couples where husbands have strong labor market attachment. So I took all the couples where husbands work and females either work or do not work. So I have earnings, I have income for each couple, but also I need to calculate what are the tax liabilities and tax changes for each couple implied by the reforms. For this, I use the NBR tax calculator. So essentially, this is tax software. So essentially, for each couple in my sample, I fill out a tax form and understand what is the size, what are their marginal tax rate and participation tax rate, and what are their tax liabilities. Okay, so one problem if we want to think about the marginal in participation tax rate is that we do not observe the income of all the women. We do not observe the income of women who are not employed. So to solve the problem of self-selection of married women into employment, I apply a two-stage Heckman procedure and impute the earnings of non-working women with exclusion restrictions from the literature. The spousal earnings and the number of little kids before the age of 5 don't directly affect the women's wage. And so then for each couple, I obtain the marginal tax rate, participation tax rates, and tax liabilities. So these are the resulting series for tax rates, and we can see that during the reforms they fell down, except the reform of 1993. However, these trends, they capture, this series capture both the macro effects, like behavior responses, different effects. So to isolate and just to get the tax, just purely reform-induced tax changes, I do the following procedure. For each couple, I fix the income, estimate the federal tax liability using this tax calculator before reform, then keep the same income and apply to the same income the after tax reform tax rules. So and then for every income of each individual, we have the pre-reform federal tax liability and post-reform federal tax liability. And changes between them are driven solely by changes in the tax reform, solely by tax reform. And so here we can see that tax reform induced changes in the tax rates. Okay, so we have this formula. Now we have all the terms that we can plug in. And I plug in and I get the following results. So here in this table, we can see on the column shown in pink is that the total gains range from minus 0.16% to 0.6%. Two important things. First is that when we abstract from the cross-spousal effects, from cross elasticities, and then the final result, and then the aggregate measure are shown in the yellow column, we significantly overestimate in absolute terms the size of the welfare gains. And also, if we model the couple, if we assume that there is some representative couple in this economy as opposed to heterogeneous couples, so then the results are also different, and we can see here, we can see the results shown in gray column. Okay, so I did different parameterization, assume different elasticity scenarios.
One more minute.
Perfect. I'm getting done. Yes. And then let me show one more result and I'm done. So here these are the aggregate effects. Even though we have a bunch of couples that have different income and they have different associated tax-induced changes in tax rate. So here I show the distribution of welfare gains, and we can see that for each reform, the welfare gain, we can have both winners and losers, so above and below zero. And this like more deep analysis of this, we can see how many couples are positively or negatively affected by tax reform. So each tax reform creates winners and losers. So also we can see heterogeneity by income, and we can see here that some monotone pattern is that higher income couples in general benefit more from these tax income reforms, which is true for all tax reforms. Okay, let me skip counterfactual and the generalization bias, and just to wrap up, conclude is that in this project, I look at the welfare effects of the tax reforms for married couples, develop a simple model that allows to derive sufficient statistics formula that allows us to estimate these welfare changes. Then I quantify the 4 tax reform implemented in the United States. The main highlights is that the tax welfare gains are quite heterogeneous across the population, and it's important to account for spousal cross elasticities of the interaction between men and women within a couple. So I'm stopping here, and thank you very much for your attention.
Thank you, Dr. Lekha. Now I call upon Dr. Sing-Cheng Q, who's from the University of Pennsylvania, to give his comments on the paper. You have 5 minutes. Hello, are you there, Dr. Q?
Can you hear me now? Sorry,
we can. Yeah, please go ahead.
Okay.
Yeah.
So you can see the slides, right?
Yeah, we can.
Okay, great.
Thank you.
So I'm very excited to discuss this paper. As is clear from the title, the objective is to quantify the welfare effects of tax changes on couples. I think the main contributions are twofold. First, the theoretical contribution is that the paper derives a sufficient statistic formula for the welfare effect of taxes in the presence of couples. And second, the quantitative contribution is that it applies the framework then to the 4 recent major tax reforms in the US. So I just want to copy and paste this beautiful equation here. I think it's beautiful in 3 aspects. First, in terms of its economic interpretation. So all of the terms are actually capturing the behavior responses to tax changes. Say it has hours margin and participation margin. It includes male's response, female's response. It includes the own elasticity as well as cross elasticity. So everything here is interpretable. And second, it's beautiful because of its empirical implementation. So all of the terms that can actually be mapped to data directly. The blue terms can be mapped to micro data like CPS, and also I'm using the MBER tax sim calculator. The red terms are elasticities extensively estimated in the literature. And lastly, I think it's also beautiful because of its substantive relevance. So why can't we simply add up all the individual effects? That's because the cross effects within couples are actually non-negligible. And then the second part of the paper is to quantify other results using this framework. In particular, it applies to the 4 major tax reforms in the past 30 to 40 years in the US. I think empirically it's super rigorous. For example, it addresses the selection issues of the participation margin, loss of robustness to alternative parameterizations of the elasticities, and as well as an extension to nonlinear tax system law HSV function. I think the bottom line is that heterogeneity actually really matters here. and the representative agent would be a poor description of the tax effects. And also the effects of tax reforms are actually very unevenly distributed. I think the work is fantastic, and it can be potentially extended in a few dimensions for future work. I think probably one interesting extension is a dynamic extension. Right now, the scope is a static framework. I think it will be interesting to think of income shocks, and then probably also asset will kick in, but it obviously will complicate the formula. But I think that might be an interesting direction to go. And second thing that I'm not sure is, but potentially interesting to look at, is whether household formation will respond to tax incentives as well. Right now, it's a unitary household model, but potentially household formation would respond, but that's an empirical question that I don't know the answer. I think that's interesting to extend as well. And just to summarize, I think this is a wonderful paper, and I enjoyed it quite a lot.
Thank you, Dr. Q. Now, the floor is open. Are there some specific questions on the paper? I don't see anybody raising the questions. In which case, I would like to call upon Dr. Malkow to give any concluding comments or reaction to the comments made. Dr. Malkow? You're muted.
Yeah, sorry, it's new software for me. Yeah, thank you, Xin-Cheng, for nice discussion. So yeah, actually you highlighted more the positive sides of it as opposed to like make some critical assessments. So I'm very grateful. So one thing that I just want to maybe emphasize, like, yeah, 2 points. The first one is about the future extensions. If I can think about the dynamic aspect, so this can also be captured by this efficiency statistics formula. So we just, in addition to the, so now the utility function depends on the current consumption, labor income, labor and hours of male and female. So then we can also include into this as additional variables, labor income in the next periods. And so this can also be captured by this. We can also do like through this solving the expansion minimization problem. This can be captured where it's actually the beauty of the sufficient statistic approach. This can be addressed. Thank you. Second,
yes.
Oh, sorry. Yeah.
Someone?
Sorry. Yeah, someone is unmuted. So the second question is actually quite interesting about the cohabitation potential effects of the tax and transfer reforms on the marriage decision. It's interesting, and it's like the question that I partly addressed in my another paper. So recently in the US and in many countries, we may see over the last few decades the rise in cohabitation. So when two boyfriend and girlfriend, they decide not to marry, but then instead they just want to live together, and then they will be taxed, as the tax rules that will apply to them will be different as opposed to the married couples. So this is highly relevant, and there is some research showing that the tax system may create this not only labor supply disincentive effects, but also marriage decision incentive effects. So, and to wrap up, one more comment that I very often receive during the talks is that I consider the unitary model of households. However, for people who study household economics, like one of the results that is like heavily documented in the literature, that sometimes unitary model fails to be consistent with empirical data, and so there is another strand of models, collective models of households. So, but then, so far in this work, I consider the unitary model, and then it's another good question whether collective modeling the household, the family, the couple, with a collective model, will it deliver different results or not, is also unexplored area in the literature, because usually people just think whether what is better, unitary or collective. It's going to be another paper that I just don't have time to work on currently, but it will be another paper in the future to see whether the responses to tax reforms described by collective model are significantly differ from the unitary model. So I think it's nice.
Thank you, Dr. Mark.
Thank you very much. Thank you. Looking forward to your presentation.
Thank you. And let me now call upon again Dr. Chen Cheng Qiu and then Eric Huang. This is a paper on precautionary mismatch, basically talking about the labor market misallocation due to constraints such as incomplete market, and it examines the implications on productivity. Well, one of the things that I see is that in the entire discussion, the institutional incentives are taken as given. But in any case, I don't want to get into those discussions at this stage. May I ask, without any further ado, may I ask Dr. Qiu to start his presentation?
For the introduction, so I'm going to talk about the project titled Precautionary Mismatch, joined with Eric Huang, and both of us are at the University of Pennsylvania. So the broad question that we are examining is the labor market mismatch, and the cost is actually both on the individual worker and also on the aggregate output. For individual workers, it may depress the wage potential and hence the wealth accumulation of the life cycle. In terms of the aggregate, it introduces potential misallocation and hence depresses aggregate output. And it's also well known in the macro inequality literature that wealth inequality and wage inequality are often intercorrelated. So the question we are after is, how does wealth affect the labor market allocation of the right worker to the right job? It has important implications for redistributive policies like the tax system. So to study this question, we would need a theory of labor market sorting with different types of workers and different jobs. We also need frictions to hinder perfect match so that we can speak to mismatch. And we also need a wealth to be interacted with the job search behavior in the labor market. So to do that, we propose a framework with two-sided heterogeneity, which give us the notion of sorting. We also introduce search friction to speak to mismatch, and we adopt the standard incomplete market framework to study the interaction with wealth. So at its core of the model is Becker's assignment model meets Diamond-Mortensen Pissarelli search framework meets a Bewley-Hagi-Diagari incomplete market framework. We're going to cast the model in continuous time so that the computation and actually analysis becomes tractable. The key mechanism to the model is the trade-off between the right match versus the speed of forming a match. Such trade-off is everywhere, but different wealth are facing different extent of such trade-off. For example, consider a wealthier worker, the marginal utility of consumption is relatively lower, and hence the worker is more willing to take risk and wait a bit longer for better matches. In terms of the firm side, it actually also faces such trade-off. So if a firm meets a worker with more wealth, then the worker tends to require a higher wage compensation, even the productivity is the same. Therefore, the match is only going to be profitable for the firm if the match quality is good. So such match, a good assignment and speed of match, this trade-off is also affected by wealth holding, even through the eyes of the firms. So this gives us an additional motif, which we call the precautionary mismatch motif here, in addition to the standard precautionary saving motif. And there are several implications, in particular that sorting would be stronger among wealthier workers, and we can test this in the data. So let me jump into the model. There are basically three key elements. First, workers are risk averse. So workers have a standard concave utility. But the second element is that workers in firms are heterogeneous, so captured by different types, say X and Y, for workers and firms respectively. If a worker and firm agrees to produce, the output is characterized by this production function F. If the worker is unemployed, it gets unemployment benefit B. If it's employed, it gets some wage. So in terms of the market structure, it's actually the third key point here. We have two market structure here. One is that workers cannot perfectly insure. There is only one risk-free asset. So this is the incomplete market. Second, the market is frictional in the sense that meetings cannot happen immediately. It has to go through a matching function here. And just to note that meetings are not equal to successful matches because of an acceptance margin. So once the worker and firms meet, they can decide whether to form a match or not. And we follow the search and matching tradition to introduce some exogenous separation shock and Nash bargaining to determine the wage. So I will not dwell on the math, but I want to quickly talk about the environment to get the Bellman equations to get familiar with the environment. So consider a worker's problem that is characterized by its wealth and the skill of the worker and the requirement of the firm captured by worker type and firm type. So the worker is making a consumption saving decision here. So the employed worker with some Poisson rate, it gets separated. So this is the employed worker's problem. The unemployed worker's problem is a little bit more complicated. In addition to the consumption saving problem here, it also decides whether to form a match or not if the worker meets a firm. And that acceptance decision will depend on the type of the firm. We will have similar decisions for the firms. The firm pays some wage, and with some rate, the job is disrupted. A vacant firm, once it meets an unemployed worker, it can decide whether to form a match or not. The wage is set by Nash bargaining. I'm not going through the derivation, but I just want to quickly show the solution to the Nash problem, which is a kind of a generalized version of the standard Nash bargaining problem because of the not perfect transferability here. So basically, the Nash solution is augmented by the two denominators here. And in particular, if we have linear utility, both of the denominators go to 1 and we go back to the standard Nash solution. And the intuition here is that $1 more to the worker from the firm is valued, the marginal value captured by the first order derivative of the value function to the worker. For the firm, $1 values $1 directly, but on top of that, it also affects the firm's value through the value function J because of a $1 shifts to the worker, so the worker becomes $1 more wealthier. So this is basically the intuition of the bargaining problem. And we have a standard steady state notion, and the asset market is closed by cleaning the asset market where the supply side is by the worker saving decision and the demand side is by the firm's value. So just to sum up, so the paper has three key elements that I mentioned in the introduction: that incomplete market, search and matching, and assignment due to two-sided heterogeneity. if we shut down two-sided heterogeneity so that workers are homogeneous, firms are homogeneous, then we go back to the special limiting economy as in Kursel, Mukuyama, Sahin 2010 paper, which basically is a combination of the incomplete market with search and matching. If we shut down the risk aversion, so workers are risk neutral, then the incomplete market essentially doesn't matter. Therefore, we go back to the standard frictional search and matching model as in Simon-Smith 2000. So now let me talk about some properties from the model. So the first proposition is that the matching set, defined as the set of workers and firms that agree to form a match if they meet, this matching set would be wider for low asset workers. And this is regardless of the assumption of the production function. And in particular, I'm going to visualize the result through two particular forms of the production function. The first one is the heterogeneity in the vertical sense. So workers are more skilled if they have higher X, and firms are more productive if they have higher Y. And there is some complementarity between workers and firms. In the right panel, I show the matching set for wealthy workers. So first of all, the yellow region, which is the acceptance region, aligns around the 45-degree line, captures the positive associative matching. But it's not perfect around the 45-degree line. There is some deviations from the 45-degree line due to such frictions. If we compare the left panel, which is for the poor workers, the matching set is much wider, reflecting the precautionary mismatch motif in the model. So poor workers tend to form matches more quickly, but usually that's not so good matches. And such proposition also hold for another type of production function. For example, this one is the horizontal heterogeneity, in the sense that workers of firms, they are all kind of different but symmetric. So different X are basically different. Think of these as different labels, but workers have their own comparative advantage, and there is no meaning of absolute advantage in this model. But we still have the matching set being wider for poor workers, wealth poor workers relative to wealth rich workers. And such negative correlation between mismatch and wealth can be captured in data as well. So here we construct some measure for mismatch following the empirical literature on skill mismatch. And I've already hinted on a natural corollary that the job finding rate is actually declining with wealth. And this is because poor workers actually accept jobs much more quickly at the expense of relatively not so suitable matches. And this can also be confirmed in the data as well, where we look at a log transformation of the wealth, and the dependent variable is the job finding. And lastly, wealth and the wage are positively correlated in the model. And in particular, this is due to two reasons. The first channel is because of net bargaining. So more assets makes the worker a tough bargainer through the lens of this bargaining protocol. And second, there is a mismatch margin that wealthier workers actually accept jobs with smaller mismatch and hence get a higher productivity on average. So this is captured by the second graph here, that you accept a better and better matches as you increase asset. So these are the two reasons why wages are positively correlated with wealth. And this is also confirmed in the data with the same specification as before. So I just quickly want to mention this Ola equation, which captures the key saving motive in the model. So this is the Ola equation for the employed worker. The first part is the trade-off between interest rate and the patience. This is the standard saving motive. We also have additional saving motive from bargaining. So workers realize that wages is going to be increasing wealth, and hence this actually poses additional a saving motive. The last term is the saving motive from precautionary saving. So because of the potential possibility of losing the job. We have a similar equation for the unemployed worker as well. But so the precautionary saving motive for unemployed worker actually depends on the matching set, which in turn depends on the wealth of the worker. So the idea is the first proposition I talk about, that the matching set is different by wealth. Okay, I'm gonna...
You have 1 more minute.
Okay, great. I'm gonna quickly talk about the model comparison between a standard Iagari model and the KMS Krusell-Mukuyama-Sahim model that I mentioned under a comparable calibration. So this model generates a joint distribution of wealth and wage. While in the Iagari model, it's a model about wealth distribution, but it's not a model about a wage. So you have to exogenously input a wage in Iagari, so which is reflected by this flat line. In KMS, they also have a theory for wage, but wage is deterministic by wealth. So there is a deterministic relationship between wage and wealth captured by the red line. So in that sense, conditional on asset, wage is degenerated in KMS, while our model generates a joint distribution for wage and wealth that is potentially useful to speak to policies that capture both dimensions of inequality. So I'm going to skip the experiment and directly jump into the conclusion. So this is mainly a theoretical work. So we develop a framework to study the wealth effects on labor market sorting. And the model produces several empirically sound relationships, and it is potentially useful to build on it to study the aggregate and distributional effects of policies, especially like unemployment insurance or taxes. Thanks.
Thank you, Dr. Q. I think it's an interesting paper. Now there is, so I have to call upon Dr. Malkov again. It looks like is it a fixed match or is it that payback time? I don't know what. Please, Dr. Malkov. You are muted. You are muted.
Yeah. Sorry. Yeah, I didn't say a lot of words. I just said thank you to Qingqian for interesting presentation and interesting paper that I greatly enjoyed to read, and I'm really looking forward to talk more about it later because I like the way it progresses. Okay, let me give some short discussion about the paper. So first, so this paper raises a highly important and relevant question. So first is, how does household wealth affect the labor market sorting? And then more broadly, how does the distribution of wealth affect the aggregate labor productivity? So, and the authors address these questions in the framework with 3 crucial elements: job search model, risk-averse workers, and incomplete markets. So their main findings are that low wealth workers, when they search for job, so if a worker has a low level of wealth, and if he or she is searching for job, then it leads to higher mismatch in the labor market. And then again, more broadly, at the aggregate level, they show that there is a negative relationship between wealth and labor market efficiency. So in addition to showing this through the lens of the model, they also document these facts empirically. That is super great. So the main mechanism is the following. So consider a low wealth worker. So low wealth worker has a stronger precautionary motive than high wealth worker. So on this worker, he or she wants to find a job, more quickly because of this motive. And so he or she is willing to accept lower wage. At the same time, it's more profitable for a firm if this worker is ready to accept lower wage. It's more profitable for a firm to hire a poor worker of any given skill type. So, and then for the low wealth workers, for each firm has more mutually acceptable matches implied by these low wealth workers, and then it leads to higher skill mismatch. So let me go. So the title of the paper is Precautionary and Mismatch. Let me go one by one. So first, I want to talk more give some more comments about precautionary, namely wealth, and then talk about skills and mismatch. So first, as I said, it's a highly relevant topic and highly relevant papers because the sizable share of the US households have low levels of liquid wealth. So here it's important is because the authors emphasize the liquid wealth, so that they're very easy to sell or obtain. So the main asset of the US households is housing, but it is illiquid. So according to the estimates of Greg Kaplan and co-authors, so between 25 and 30% of the US households are hand-to-mouth. So these are the households that consume out of their current income. So 1/3 of these households are poor hand-to-mouth, who have no wealth at all, and 2/3 are wealthy hand-to-mouth, those whose wealth is represented mainly by illiquid assets, so retirement accounts or housing. So sizable share of US households are actually have low wealth, and hence through the lens of this paper, we can see that there is a higher risk of skill mismatch in the US labor market. So one question is that if we look at the wealthy household, how important is labor income for them? But again, since the significant share of households don't have any wealth, have low levels of wealth, it's like it really matters at all for them, the labor market income. So another angle that we can look at this problem is that we can relate it to some.
One more minute.
Yes. Yeah, thank you. Is that we have some wealth gaps based on some observables. For example, a racial wealth gap. So and like in this graph, we can see that Black people and people that have Latin American ethnicity, they have the share of household that have zero negative net worth significantly higher than for white or in general the economy. So this another. This paper sheds light on how the racial wealth gap that exists can be related to labor market efficiency. So let me quickly talk about the skills. So given that this paper is discussing the potential skill mismatch, so there are three main points that I want to highlight. First, there is a recent trend that is started from following the Great Depression, a Great Recession, is a skill upgrading in the US labor market. So the firms increase the skill requirements for routine cognitive occupations. So this is the middle part of the wage distribution, and then potentially an interesting model exercise is to increase in skill requirements, perhaps not uniform as the exercise that you look at when you hit the wealth stroke. So another thing is that the existence of asymmetric cost of mismatch in the paper by Jeremy List and Fabian Postal-Vinay that you referred to. So is that they show that it's better to be overqualified than underqualified when the cost is measured as output loss and loss of work utility. So another thing that also makes this paper even more important is that the relationship with the COVID-19 pandemic. So there is evidence that workers who had non-teleworkable jobs, those who cannot work from home, they have high risk of job loss. In my work, I show that these non-teleworkable occupations have lower cognitive skill requirements. Hence, it means that these guys who could not work from home, who were more likely to lose the jobs, and also they have lower level of cognitive skills. So does it mean that higher skill mismatch will persist in the post-pandemic labor market? So it's an interesting question that you can potentially address in your paper. But overall, the great paper, highly relevant question. I really like the elegant title, like the top 5 title, the top 5 journal. So make us think harder about the interaction between wage and wealth inequality, and more broadly about between labor and capital markets. And so there is a huge scope for policy recommendations, and I greatly enjoy and I'm more than willing to talk more about it like in the future. Thank you.
Thank you, Dr. Malcolm. And there is very little time, but then if there is somebody who is wants to ask a question, I will allow one question. Is there somebody? Okay. If that is the case, Dr. Q, do you want to respond to the? You'll have only 1 minute.
Okay, great. Okay, let me be short. I really appreciate the discussion and constructive suggestions. So let me just say a few things about this precautionary part and the mismatch part. Indeed, the precautionary part is about illiquid asset. Here we do not endogenize the distinction between illiquid asset versus liquid asset. Sorry, I meant to say this model is about liquid asset. So we do not endogenize the distinction between illiquid versus liquid asset, but we just focus on liquid asset. For the mismatch part, I also agree that the lease and post-of-INA, they actually have a much richer structure on the introduce the multi-dimension of the skills and richer structure on the different directions of the skill. We potentially want to introduce that as well. And I would also like to take a look at your paper about cognitive skills. Thanks a lot.
Thank you. Thank you very much. Now we move on to the third paper, which is how well targeted are payroll tax cuts as a response to COVID-19. This is evidence from China. There are 3 authors, Dr. Wei Kui, Dr. Jeffrey Hicks, and Dr. Max Norton. The first author is Allard Law School, University of British Columbia, and Dr. Hicks and Norton are from Vancouver School of Economics, University of British Columbia. It's an interesting paper. Again, I don't want to go into the details. It actually brings out the social insurance exemptions, sort of are beneficial they bring windfall benefits to large resilient firms, but they provide insufficient support to small and vulnerable sectors. So with this, let me invite Dr. Gui. You have 15 minutes.
Great. Thank you. I hope you can all hear me.
Yeah.
So
thank you.
Let me...
Loud and clear.
Yeah, great. So I just want to get this going. Okay, great. Thank you. I want to thank Professor Rao, Professor Chakraborty for organizing this panel, and of course the other organizers. Also want to thank Xin Cheng for improving the match in this panel, for regrouping the papers together. I really enjoyed hearing your comments on each other. So as Dr. Rao pointed out, this is joint work with Jeffrey Hicks and Max Norton. Both of them are online now. So a major challenge of public finance in developing countries is building a universal social insurance system. The COVID pandemic highlighted the significant social insurance. It has also reinforced pre-existing concerns about SI systems, for example, those arising from the expanding gig economy. So studying how to build SI systems with broad coverage and a well-enforced contributory base in developing economies is an important topic. We studied this topic in the context of China's evolving SI system. Social insurance in China shares many weaknesses observed in SI systems in developing countries. These include high payroll tax rates, low participation, low compliance, and challenges to sustainability in the face of aging populations. At the same time, social insurance contributions now represent almost 30% of total tax revenue, and so that's a sign of some success. In fact, the Chinese government offered its largest fiscal policy response to COVID-19 in 2020 in the form of reductions in employer contributions to SI. These reductions to just three insurance regimes, pension, unemployment, work injury, sum to $239 billion US. So how do I get to the very end right away? Let's see. Okay. What we aim to do in this paper is to
Wait, it
I
looks
think,
like your slides aren't advancing.
is that
Yes.
right?
Slides are not moving. Yeah.
My slides are not moving?
Yeah.
We're still on the title page.
You're still on the title page.
So we use a novel data set of tax returns from one large prosperous province to study SI. And prior studies at the firm level, using firm level data, use the annual survey of industrial firms. The main limitation of that data are two. One is that they are about large firms. And so that's poor for studying social insurance participation, for studying informality. And they also end in 2008. So the social insurance system in China is evolving very fast, and so it's important to have more recent data. Our data goes from 2010 to 2016, and we focus on 2016 for today's paper. I want to emphasize two features of our data that's really special. That's relevant for not just studying China, but also for thinking about studying informality in the other parts of the world as well. China is unusual in having a high level of taxpayer registration. So close to 90% of the firm taxpayers in our sample, and this is for firms and not for individual proprietors, they are micro firms. And so basically, these are firms that would not show up in databases elsewhere. What this implies is that there's a high level of what you can call firm formality or low level of firm informality in China. But informal labor is prevalent in China, so we still have high labor informality. What we're able to do then is to leverage high firm formality to study labor informality in a very wide range of firms. Secondly, our data allows us to observe two margins of labor informality. The first one is whether firms participate in social insurance at all, whether they make any contribution. And the second is how much they contribute. It turns out that this first extensive margin informality is hard to see in other data. There's very little work of this kind, but it's easier to interpret, and there's less measurement error. And so we're going to be showing some results using this measurement. So I'm going to go back to one slide. The overall purpose of the presentation is to document some general patterns in SI non-compliance, to explore the role of China's highly decentralized SI financing system, and then finally, if I have time, document some of the likely impact of the 2020 SI exemption reductions. Okay. So for institutional background, I'm going to be very quick. This one figure tells you some basic facts for the social insurance system that I'm going to be talking about comprises 5 elements. The largest one is pension insurance. There's medical insurance, and then that's followed by the smaller unemployment, workplace injury, and maternity insurance regimes. What you see in this figure is the rate structure of these 5 insurance schemes. And what you see here is down here, you have this kind of rate, and then there is sort of a linear tax rate, and then it goes flat. The reason is that the tax base for social insurance contributions has both a floor and a cap. And so low-wage workers have to pay a minimum amount of social insurance contributions, whereas high-wage workers do not pay above a certain level. And one last thing you can see from this is what we're listing here is employer. Oh, I think, Jeff, did you update this to employer and employee? Okay, so this is the combination of employer and employee contributions, and if you add up the rates, it's very high. It's well over 40% payroll taxation. Okay, I'm going to now show the first result in our paper using the extensive margin measure of participation, so whether firms participate in SI at all. What you see here is a very interesting pattern. We see a clear size gradient of participation. Overall, only 46% of firms in our data participate in SI at all. Remember, contribution is mandatory. This is a mandatory urban employment-based social insurance. More than 50% of firms do not participate. The firms that do participate account for 76% of aggregate business revenue. This means 54% of firms and 24% of economic activity happen outside of the formal SI system. Participation is much lower among small firms, rising from only 22% in the lowest decile, going up to about 78% in the top decile. The largest decile of firms account for 73.8% of total insurance contribution. So you can see this here. And this pattern holds if we use a different measure, if we limit firms to those that have significant wage reporting. So why is that? There are many things that could be explaining this pattern. We'll show one thing here that is simple, but it's a useful visualization. We calculate the average tax rate on each firm by first calculating the average wage per worker in that firm. And then we apply the statutory tax rate to that wage. And then we sum up the average tax rate in a particular firm decile. What you see here is that smaller firms bear a very high average tax rate. And what the blue series shows is non-contributors, whereas the this other series shows contributors. So the average tax rate is much higher, significantly higher for non-contributors, and this suggests that these firms select out of the SI system and the contributors select in. So we do have, in the current version of the paper, we don't really discuss other firm level determinants of participation. This is partly because the cross-sectional exercise yields limited insights. We do have a COVID policy evaluation section of the paper where we discuss the interaction of reduction of SI with firm level characteristics such as business costs and liquidity. But before turning to that, I want to show a novel set of findings we find in respect of the institutional structure of the Chinese social insurance system. Essentially, even though China's national government tells the entire country what the social insurance system is supposed to be, provinces set tax rate, but really social insurance is pooled at very decentralized units. There are about 2,000 separate local social insurance authorities that pool SI premiums and obligations and administers the program. What we want to do is to find out whether these below city level, prefectural level units drive geographical variations in inside compliance. Previously, empirical studies tend to analyze variations at the prefecture or city level. We're going one level below. Specifically, we're going to be finding that 45% of geographic variations in participation are accounted for by pooling units at this very decentralized level. And then we're going to have an exercise studying what is the mechanism by which facts about pooling units decide participation. What we find is that current pension expenditures, the larger is current pension expenditures, the larger is the firm level compliance. Okay, so to show those two findings, let me first show you that in this graph, we calculate the rate of participation at a neighborhood level, which is defined as the fraction of firms in neighborhood that remits SI contributions. Neighborhoods represent granular divisions of districts. There are about 17 neighborhoods per district on average. And this is the lowest level of geography available in our data. And then we plot the distribution of participation across neighborhoods, with neighborhoods weighted by the number of firms present in them. You can see a lot of variation, and it's important to emphasize that this is within a single province. So we actually perform a variance decomposition, and so we look at the determinants of neighborhood level participation using some controls. So going from left to right, we add in some controls. And if we look at the bottom two rows, this first row is going to explain to display the amount of variance that's explained by polling unit level observation variation or above. And the next one is going to be within polling unit unobservables. And so what we see are, this is the most important number to see, is about 46.6% of the variance at neighborhood level is explained by variations above the polling unit level or at the polling unit level. 34.5% is explained by unobservables at the within polling units, and then the remainder, about 19%, explained by these control variables. So we now look at the impact of budgetary pressure on extensive margin participation. We're exploring political hypothesis. Polling units facing budgetary pressure will enforce social insurance more, leading to higher social insurance compliance. So we gathered budgetary data on the polling units, and this is actually has not been done in the literature before. So increasing budgetary transparency allow us to gather budgetary data at the polling unit level. And so we calculate a measure of budgetary pressure by dividing total pension outlays in the unit by the product of the total working age population in that unit and the local mean wage. And this represents an estimate of the total potential contributory base. Budgetary pressure, the outcome variable, therefore captures, or the important independent variable, is going to capture the share of current local wage income devoted to funding current local retiree pensions.
You have two more
minutes.
minutes.
Excellent. The higher is this share, the greater the need for local authority to collect SI contribution. So in this table, you can already see that the figure is strongly positive. And so this is going to mean a doubling of budgetary pressure leads to about 3.33 percentage points of increase in social insurance participation. In this next figure, we visualize this correlation, but this time the outcome variable is on the intensive margin. We basically calculate the difference between actual contributions and imputed statutory contributions. That difference is the intensive margin compliance. And then the next one is the total effect of extensive margin and intensive margin and compliance. And we see a strongly positive correlation as well. So that's a novel exercise that was not previously done because people have not analyzed this kind of variation at the polling unit level. So if we have a result about spillover to other taxes, but let me quickly get to the COVID results just to summarize. In 2020, the Chinese government decided for 5 months in the initial month of the pandemic to provide complete exemptions from 3 types of insurance: pension, UI, and injury, to non-large firms. Non-large firms are basically the 99% of firms. Large firms are only less than 1% of all firms. And for large firms, they got a 50% exemption. And different provinces also gave exemptions to medical insurance contributions. And this was relaxed, this was reduced later, so large firms no longer benefit from these exemptions in the second half of the year, but small firms continued. All of these policies have ended by this point. Basically, the punchline of our study is that even though lots of firms, 50% of firms benefit not at all from this policy because they were not participating in the social insurance system in the first place. Still, we saw that on average, smaller firms got a greater amount of subsidy relative to their costs. And so if you see the firms that participated in the size system, you will see this downward sloping curve where the smallest firms receive the largest amount of subsidy relative to their costs. And even if we combine participating and non-participating firms, smaller firms received relatively more subsidy. And so it's not a complete disaster delivering pandemic response in this way. Okay, I'm going to stop there. I probably went over already. Thank you.
Thank you, Dr. Wei. And now we have discussant in Dr. Laura Zimmerman. Laura Zimmerman is from the Department of Economics and Department of International Affairs, University of Georgia. You have 5 minutes. Please go ahead.
Thank you very much. Yeah, so this was another amazing paper to read. I very much enjoyed the opportunity to take a look at this. Clearly a very important question on using amazing data. And so I'm going to jump around here. I probably don't have time to go through all my slides, so I'll send those to you in case this is useful. But I wanted to jump in right away with maybe content-wise, where, and I know all of this is work in progress, but maybe where I can be most helpful in maybe thinking through some issues. And so just as a brief summary, so the paper uses an amazing data set actually of firm data, which has the universe of firms from a big province in China from 2016, merges that with information on the number of employees that's available only in 2017, although it's not quite clear which year actually that number of employees refers to. So that could have been at some point before 2017 as well. And then we have census data on the working age population from the 2010 census. And all of that in part is then used to think about, well, what might be the impact of the COVID policy in 2020. And so that's a really cool idea, but of course, given the different timeframes here, raises the potential concern maybe about measurement error on a number of dimensions. And so one thing that's discussed in the paper is sort of the idea that, well, maybe the number of employees might induce measurement error, although I think the assumption is that that might be classical. And while I agree that there's a good a reason to believe that that might be true, I was wondering whether you're able to maybe provide a bit more justification or evidence that this would be plausible, because we could be worried that measurement error might be systematic, right, either across locations or across firms based on the, in some sense, the delay or the gap between sort of when the information was entered into the tax registry database and when it is accessed in 2017, which is unknown. And so to the extent that there is some kind of information out there on what kind of situations might trigger an update to the number of employees in the system, that might be very useful to know. Or maybe there's anecdotal evidence out there on how often firms go back and update information in the tax registry, and whether that might be likely to differ by things that we would care about, or that would be problematic in the sense of, or in the scope of this analysis with respect to industry, firm size, revenue, probability of contributing to SI, and so on. Similarly, at some point you raised the potential concern that there might be an underreporting of employees strategically by firms, in which case I think you might have a downward bias in the ATR you're calculating. So again, might be useful for us to think through this in a bit more detail. The other thing that I was trying to think through that maybe would be useful to have a bit more discussion on in the paper is how this relates to the working age population, which you basing on information you're getting from the 2010 census. So you define the working age range as 15 to 65, even though, as you point out, women typically, the official retirement age would be 50, 60 for men. So my understanding on the Chinese retirement system is that there's a discontinuity, so the probability of being retired jumps up at that age cutoff, but it's not going from 0 to 100%, right? So it probably makes sense to extend the working age population past that age. But again, there might be concerns about, is that systematically different across industries, firm sizes, or even across locations, right, in a way that might influence the analysis systematically. Should we worry about the retirement entry itself being endogenous, right? So you, I think, show very convincingly, and for me as a political economy aficionado, like a lot of really cool results suggesting that local governments might endogenously determine the effort they expend on enforcing SI contributions. Do they do something similar? Maybe with retirement age entries, is there scope for them to do that? Might high pressure, budget pressure locations, for example, maybe try to discourage workers from retiring, and so would that influence the analysis? And then should we be worried maybe about migration or population growth patterns having changed systematically between 2010 and 2016? Yeah, so that maybe on the more nitty-gritty side, content side. Otherwise, I mean, I was mostly wondering about framing and big picture question, and about the question of external validity, or how much can we generalize from the results you're presenting. My understanding is that you probably can't share which province in China you have the data from, but maybe there's a bit more you can tell us about how likely this one province example is to generalize to China. Right? Would the industry breakdown, firm size distribution, average tax rates, or something? Would we expect something similar if we had data on a different province or on China overall? How typical is 2016 as a year in China? So that might be helpful just to give us a sense of how much measurement error we have to live with if we're extrapolating from 2016 to then looking at the COVID policy response in 2020. And then on the framing side, if we're thinking about, well, who else might this apply to, or how kind of interesting overlap is there with other papers in the literature, I was a bit surprised to see that you're right now framing the paper very, very narrowly, right? So there's a paragraph where you're basically saying, well, we're mostly interested in understanding the Chinese SI system a lot better than we do. We have better data than everyone else. And I wholeheartedly agree, right? China is a massive country. SI is a very, very important topic. So certainly we should care about this on its own in the context, but you're probably underselling the contribution you're making. And I was particularly thinking about other cases where labor informality can be a bit better studied because you have sort of a larger universe of firms, both big and small, where you can observe these patterns. And I think a lot of that comes from Latin America, Mexico, Brazil, and so maybe with the more labor literature that might be interesting to bring into the fold here. And then lastly, and I think I understood, I think, a bit better in your presentation how to maybe think about the priorities or what you're viewing as the main research question. I was mostly wondering, is this the kind of paper where you have a research question or a puzzle, right, that you're setting up that you're then answering, or is this the kind of paper where you have a stylized fact set, right, or a number of interesting observations and bits and pieces that you're bringing to the table? And at various points in the paper, it sounded like you were either doing one thing or you were doing the other. But it certainly sounds like you're probably more in that area up here where you're really taking full stock of the SI system in any shape or form that you can with the data that you have, and then sort of folding sort of puzzles and other questions into this rather than maybe having that as a sort of your main headline finding.
Dr. Zimmerman, I think we have completely run out of time. And I'll give just 1 minute for responding to the comments.
Absolutely.
Yeah.
Thank you.
please go
Thank
ahead.
you. So, yeah, very quickly. Thank you so much for those comments. I agree. We're very aware that when we present any results that uses the number of employees and sometimes even wages, there could be measurement errors. And at this point, we don't have very major results that involve these figures. By contrast, the thing we like about the extensive margin participation is that it seems to be relatively clear cut. And in some ways, we'll try to get as much out of that as possible. That is the basis for the analysis of the 2020 policy. There is just complete exemption. And so our challenge there is to project from 2016 remittance patterns to 2019, let's say. I also agree that in some ways, this is both a topic and a paper in search of theory. And so I think theory will help examine external validity. When we look at papers from Brazil and elsewhere, studying similar phenomena, firm level determinants of participation, in some ways, the pattern is universal, tax rates, small firms, and so on.
Thank you very much. Now we quickly move on to the last paper in this session. The paper is on the production and evasion responses with limited state capacity, evidence from major tax reforms in India. This is by Dr. David Agarwal and Laura Zimmerman. And now I just want to make a couple of things. I think there are some shortcomings in the actual presentation of the history and the way in which the entire thing has happened in this paper. I don't want to go into the details. Having worked on the major tax reforms in India myself, one is the entire reform of the value-added reform in the sales tax system to value-added tax, and later on to the goods and services tax. It's not that the central intervention or the central government decision to do that had happened. It was the states getting together. In fact, there was an empowered committee of the state finance ministers which was driving the entire scheme of things. And then, of course, there was the central government was only an observer in that particular thing. And then eventually, it was the states some of the states that prevented the reform. And eventually, eventually, obviously, the central government came in. That's one. The second issue is, somehow or the other, the paper said that the service tax was a part of the SENVAT, which is not. There was a separate service tax, and there was a SENVAT. Also, obviously, the things were actually put together only when the GST came into picture. There was a committee which I chaired way back in 2000, where which said that you need to integrate the goods and services tax together, taxes on goods and services together. So obviously this happened much later. And finally, there were studies on in fact, there is an important paper by Arindam Dasgupta, which basically evaluates the impact of the introduction of value-added tax on the productivity of revenue productivity in the states. And there is also a more recent paper by me, which was presented on goods and services tax, which was presented in Columbia University. Which basically talks about state-wise impact of the value-added tax. In any case, I mean, there's an interesting paper. It's an important paper. I don't want to go any further on that, discussion on that. Since I had done some work in that, I thought I will make these observations. So now I will immediately call upon Dr. Agarwal and Laura Zimmerman to make the presentation, followed by Dr. Veiku's comments. Dr. Zimmerman.
Yeah, thank you very much. And also thank you very much for these comments. And if I may follow up with you about some of these, because yeah, it is of course a bit ridiculous in some sense for me to present the papers in the presence of some of these big experts here that we have virtually present. And so this is still very much work in progress. And so certainly any comments and suggestions are very much appreciated. Yeah, so we're really interested in the question of sales tax versus value-added tax systems, which have really increased massively in popularity over the last 30 years. And so we go from about 50 countries with a value-added tax system in 1990 to 165 countries by 2016, with most of the recent adopters being developing countries. And so that raises the obvious question of, is that a good move, and how big are the benefits relative of potential drawbacks between the two systems? Certainly the IMF and some other organizations internationally take a clear stance towards encouraging the adoption of a VAT system. When we look at sort of public finance theory, that traditionally certainly highlights the big efficiency gains of a value-added tax system. Again, I'm sure this is not news to really anyone on this call, but just briefly, right, the typical idea is that a value-added tax system requires firms to only pay taxes on the value added in a particular production step, so on the difference between the value of sales and purchased inputs. And the idea is that that really lowers problems with double taxation or cascading taxes relative to a sales tax regime, reduces incentives to vertically integrate, and therefore improves production efficiency. Similarly, the other big benefit typically highlighted is that in order to receive the tax credit, firms under this VAT system have an incentive to truthfully report the input purchases and thereby generate a paper trail that makes it a lot easier for tax authorities to cross-check receipts, and that might make tax evasion a lot more difficult than under a general sales tax regime, for example. So overall, therefore, the VAT generally considered to be a more efficient tax system, particularly if there's concerns with weak state capacity. On the other hand, there's also reasons to think that there might be concerns with this simple idea that the VAT would be necessarily a priori more effective. So one concern particularly relates to the informal sector. So firms have the opportunity to endogenously adjust their turnover, their revenue to, for example, be just below a threshold at which they would have to formally register and start paying taxes. Then maybe a reform that makes tax evasion harder might actually encourage many firms to move from the formal to the informal sector, or to stay artificially small so as not to have to become formal. And that would, of course, negatively affect tax revenue and might have negative impacts on production efficiency. Similarly, there's a couple of recent evidence from a number of contexts showing that just the existence of the paper trail itself does not necessarily help reduce tax evasion if tax authorities lack, for example, the technology, otherwise lack the capacity to really take advantage of that, because then a tax evasion or detecting tax evasion does not become sort of a credible threat. And then, of course, as with any ambitious policy reform, implementing a VAT system on its own does not necessarily resolve other challenges that might be present, ranging from political economy concerns over maybe high compliance costs of a very complex system, especially for smaller firms. And so all of these might make sort of the plausibility of the classical efficiency argument by Diamond and Murley's maybe a bit less appealing than one might otherwise think. And so what we're doing in this paper is looking at India's VAT reform. And so we're looking at the mid-2000s reform, as Dr. Rao already pointed out. We're not looking at the more recent GST adoption in 2017, but really at the reform taking us from sort of the state-specific sales tax to the state-specific VAT. We're going to exploit sort of the staggered rollout of the reform across states. And we don't have time to go into this today, but as part of the paper, we're actually constructing, based on state reports, going to the websites, going through all the notifications on tax rate changes, an extensive data set of state and product specific tax rates before and after the reform that we've now actually merged to the ASIC codes in the ASI. And so that will allow us to look both at complexity of the tax system as well as to actually calculate a firm specific effective tax rate. So these are things to come, but unfortunately not something I can show you today. I'm also going to mainly focus on the production responses rather than on the tax evasion in this presentation, again, for sort of time reasons. And so because of that, during today's presentation, the main research question really is about the causal impact of the transition. So what is happening to firm sales in the aftermath of the reform? Yeah, again, no introduction necessary for a lot of this, but just as a brief summary. So if we think back to the sales tax system in place, most Indian states adopted sales tax in the 1940s and 1950s. And so by the early 2000s, there's a lot of state variation on tax rates, a number of tax rates, exemptions, or other kind of idiosyncratic changes geared towards particular industry, for example, that made this a relatively complex system, and by some estimates induced large distortions to supply chains through this cascading taxes concern. This is just to serve as a bit of a reminder of the variation in VAT introduction across Indian states. So this is the first half of the alphabet here, roughly speaking. And so the first adopter of the state-specific VAT was Haryana here on April 1st, 2003. You can see here lots of adoption in 2005 and 2006. And then if we look at the late adopters, you have particularly here Tamil Nadu in 2007, and then the last adopting country, last adopting state, Uttar Pradesh in 2008. In terms of firm data, we're using the Annual Survey of Industries, ASI, which again, everyone here will probably be familiar with. It has well-known advantages and drawbacks, particularly that it's well-known that the sampling frame excludes small firms with fewer than 10 workers or 20 without electricity, which excludes an important part of economic activity. On the other hand, most of these firms would not really have been anywhere near to a threshold where they would have to formally register under a sales tax or the VAT, and so we're hoping that the drawbacks of that for our particular study are comparatively limited, at least on the production responses side. In terms of research design, we focus on an event study analysis, exploiting this sort of staggered rollout of the VAT reform. If you're following sort of the recent, it feels like almost daily updates on the difference in difference literature, you might be well aware that there have been a couple of concerns that have been raised about sort of the typical average treatment on the treated effect, ATT, and the assumptions that we might be inadvertently making when we claim such an effect is causal. Focusing on the event study already gets around some of those concerns, and in our case, we're actually quite interested in observing the dynamic impacts and seeing whether the reform had larger impacts that added up over time. And of course, typically an event study is also appealing because it helps to visualize and critically look at some of the pre-treatment trends and to get a sense of the plausibility of the parallel trends assumption. Nevertheless, traditionally, if you implement a two-way fixed effect specification of an event study, you might be running something like this, where we might have the outcome of interest. In our case, that will be log sales regressed on year fixed effects, state fixed effects, and then individual indicator variables for each of the pre-reform and post-reform time periods. interacted with a treatment indicator for the reform, as well as potentially any other control variables. And as Dr. Rao pointed out, too, when we're thinking about early versus late adoption, states had a lot of agency. The center couldn't mandate VAT adoption. And so there might be concerns that early adopters are systematically different from late adopters. And there might be concern about political considerations. So certainly all BJP-led states implemented in 2006, for example, rather than in 2005 with the bulk of other states. We might be concerned about economic considerations. So a lot of pushback from the trader community, lots of demonstrations, for example, and strikes. And we might be concerned about the election timetable, right? And understandably, states probably being hesitant to implement a big reform in an election year, for example, or otherwise as an incumbent government if there was fear about losing the next election if the introduction was too close. So I'm going to show you results both with and without covariates here. So recent econometric papers such as Sun and Abraham have pointed out that in running a two-way fixed effect specification, we're really making three assumptions. Number one, that there are parallel trends in baseline outcomes, potentially conditional on covariates. Number two, that there's no anticipation effect prior to reform adoption. And then number three, that there's treatment effect homogeneity across implementation groups, so across early and late adopters. And it is especially, I think, assumption three that we are typically especially worried about. And Sun and Abraham and others have shown that actually if this assumption fails, this will in some sense also bias pre-treatment coefficients. And so we might actually mistakenly plot event studies and think there is no problem with pre-trends when really they have been contaminated by the bias introduced from a failure of this third assumption. So what do we do instead, or in addition to showing you the two-way fixed effect specification? In the literature, there's by now a number of potential solutions that really apply to different contexts or specific institutional setups that you might have. In our case, we actually think the most recent, the Gardner 2021 paper, provides the most attractive solution. It actually allows us to estimate an unbiased overall ATT estimate, as well as sort of an unbiased event study specification in the presence of treatment effect heterogeneity. It's a two-step process that is actually very intuitive. I won't go into the details now, but certainly if you have not read this particular paper, I would very much encourage you to do so. Getting to the main results here, this is the two-way fixed effect specification without covariates. So this is the one that is potentially subject to bias here. Reference category is the year before the reform in all states, so period -1. If we take this as is, right, this would suggest that there's not a lot of pre-trends here to worry about, but that in terms of statistical significance, we might have a bit of a concern here. It would certainly suggest that the reform in the post-treatment years here has sort of an accumulating positive effect on sales here, leading us 4 years out after the reform to an increase in sales of close to 50 percentage points. So a pretty large effect. If we go to the Gardner specification without covariates, so this is the one that should be not really subject to bias. Again, pre-trends actually look pretty okay. And again, we find an increase in sales in the aftermath and about a 34 percentage point increase sort of 4 years after the reform. If we add covariates, both economic and political, pre-trends here, as you can see, look a bit better. Otherwise, we find a very similar pattern. And so if I go to the table version here, where I've only, to make this legible, plotted or written up the post-treatment coefficients here, you can see the 4 specifications here. So this is the two-way fixed effect without covariates, with covariates, and then the Gardner without and with covariates. And so we land here on a 33 percentage point increase in sales for the typical firm in the ASI data set. In a separate specification, we can also estimate an overall ATT for the entire post-treatment period, landing us on average 27 percentage point increase in sales due to the reform. And then just to conclude here, so overall, we are finding that the VAT reform leads to a positive production response among manufacturing firms. It's large, but maybe not crazy large. So that it would be implausible. In the paper, we also take a look at the tax evasion response, which appears to be small in comparison, although we don't have a lot of power at some of the registration thresholds, given sort of the oversampling of larger firms in the ASI. But it looks like the overall net benefit of the reform is positive and might sort of be a very maybe encouraging sign about the production response or the increase in production efficiency as part of the reform. And with that, thank you very much. And I'm
Thank
looking
you.
forward to any
Thank you
questions.
very much. In fact, I will not go into anything at this stage. Let me invite Dr. Wei Kui to make his observations on the paper.
Great. So I feel torn. I'm actually very interested in hearing what the Indian public finance specialists have to say about Laura's paper, but I also feel that I'd like to hear a little bit about what they would say about some of my arguments. And so just to briefly summarize the paper, so I hope I'm advancing my slides. Are you able to see that? Yeah, okay. So this is a paper that studies the gradual introduction of the VAT to India's manufacturing sector between 2003 and 2008, which took the form of state-level reforms that replaced existing turnover taxes. My understanding is that this was probably the biggest indirect tax reform happening in the world at that time, and so it attracted a lot of attention around the world. And it's delightful to have a paper studying this important topic, even though this is about 15 years later. The paper that struck me as most important, the part that struck me as important is that it appears to identify a positive and large causal effect of the reform on firm sales, which the authors interpret as productivity gain attributable to a VAT design. There's extensive econometric discussion of difference in difference for staggered treatments, presumably because the importance of establishing this important empirical result. A lot of the paper does also dive into institutional details, so a couple of things that are highlighted. First, Laura and David produced the first ever comprehensive product state harmonization of the Indian commodity tax system, and they also matched the tax rates to create an effective tax rate for each firm in their firm database. And that's on each of their inputs and each of their outputs, and this produces overall firm-specific ETR. So this second set of descriptive work currently is not used in the empirical analysis, but there are suggestions that this is something that's going to be used in the future. And then there's evidence of bunching, even though it comes from the same data, not entirely sure that it's related to the reform. And so for VAT thresholds, you can probably find some bunching at any point. Maybe this is just a particular snapshot that happens to coincide with the introduction of the VAT. So the main thing I want to ask, I want to talk about is the following, and this is the part that I'm very curious about the Indian specialists' view. My question is, a priori, how much productivity gain can we expect from the reform that happened in India? And so when I heard about the Indian reform in the early 10s, there was extensive discussion. There's call for further reform. The idea is that there's still lots of imperfection in the Indian indirect tax system. And so here are a few things that VAT specialists tend to regard as major flaws with the system. And so to start, the post-reform VAT system did not cover services. There is a federal VAT on services. It's not quite clear to me what the interaction with that is. There was the presence of other distortionary taxes. So there was a central sales tax that was not creditable by firms. And so you have discretionary taxes on the same transactions. The VAT treatment of interstate transactions was also a work in progress. The fact that you have uneven introduction means that you have imperfect crediting both on the input side and the output side when you have interstate transactions. The state system was origin rather than destination based. Usually VAT design advocates for destination based VATs in subnational systems. It was complex with multiple rates. The refund of excess VAT input was incomplete. It was not clear from the paper whether the reform was designed to be revenue neutral. You mentioned that tax revenue increased a lot. It was not quite clear whether that was VAT revenue or sales tax revenue or it was something else. But in case there is actually an increased taxation overall, it would be actually interesting to say just because there are some efficiency gains, a large increase in overall taxation is productivity enhancing. So perhaps I can just emphasize this question. Consider the question, what is more discretionary? A VAT that applies to multiple links in the production chain, but that removes tax on B2B transactions only incompletely, and where many links are broken. This is all of the exemptions, services sectors not covered, lots of non-registered firms, or a single point sales tax collected only at one intermediate point in production. That's a stylized version of what existed before. It's actually not clear to me that the latter is more inefficient. Okay.
Now, I think we should just, in the interest of time, let me ask Dr. Zimmerman to quickly respond, because we have already overshot time. Yeah, Dr. Zimmerman.
Yeah, maybe in the interest of everyone's time.
Only 1 minute. Yeah.
Yeah, let me actually just not respond at all and just very much thank Wei, thank you, Dr. Rao, thank everyone who's sticking around and say that I'm very interested in any other comments anyone might have. Everyone should feel free to reach out to me via email and leave it at that.
I think, before concluding, I just want to say a couple of things, in response to what Dr. Wei raised. See, in fact, even though they say that it was done unevenly, see, most of the states got into the value-added tax in 2005, and Haryana wanted to, to get into earlier, but then in fact, they coordinated and then harmonized it along with the other state taxes. In fact, this was all agreed upon by the different state governments. And then the two of the states, the Chandigarh and the Pondicherry, are basically union territories. They are not really the states, and they are very, very small parts of this thing. And then UP was, there was an election, so they moved on, and then again the system was broadly uniform across the states. But you are right that this was not a complete VAT in that sense of the term. It was partially origin-based, partially destination-based, because central sales tax was one of the things that existed. But everything was over when we moved over to a goods and services tax in 2017. In fact, now the goods and services tax is a unified tax. There is no separate, sort of central state tax. It taxed at one point. Both there is what is called the central tax and the state tax are collected together, and they are credited together. The input tax crediting is done together, and so goods and services are together. There is no separate taxation of goods and services. There is still, it's a work in progress. There has been a lot of improvement that has happened. Unfortunately, the technology platform did not. That is the most important thing when you're talking about the state capacity. Technology platform did not firm up itself properly until very recently, but now it has firmed up. But unfortunately, because of the COVID, there's a lockdown, and then the revenue impact is not seen because of the COVID, pandemic. But I think once the thing is over, it will be substantially better tax than they existed earlier. I wouldn't say that it is a final destination. It is a work in progress. There is a paper that I wrote in 2017, 2018, which was presented in Columbia University School of Public Policy in their this thing, which, I mean, I can be reached out, if you send me the email, I will send the paper, which basically gives you a substantial version. And then, because the petroleum products is outside the goods and services tax. I mean, that's one, or the electricity is outside the goods and services tax. And these are the things which contribute to a lot of, cascading. And then that continue to be the problem. There is a lot of discussion that is going on. There is what is called the GST Council now, which consisting of both union and the states to take decisions. Anyway, I leave it at that, and let me thank my colleagues from the National Institute of Public Finance and Policy. I used to be the director of this institute for 10 years. And so it's always a nice thing to be back. Thank you, Pinaki, for inviting me. So thanks to all of you for putting up, because in the limited time span that we have, I had to ask people to we have lots of ideas, but then unfortunately the time is very limited. Thank you very much.
Thank you. Thank you.
Thank you.
Thank you.
All right.
Thank you.
For the rest of the conference.
Thank you.
Thank you.